Hi, hello everyone, and welcome to Traders Talk. Hi, this is Ming Hon, your host for Traders Talk today. And let let me just close the mic. All right. Okay. Yep. All right. Great. So this week we are in for a very exciting week, and of course, if you guys have followed the market, last week was a very good week for the bulls, not so good for the bears. Yeah. And of course, market goes up and down, but of course, for the past 7 weeks, we had only seen rates. Yeah, for the past 7 weeks, we had only seen rates, and for the first time uh, last week we had a green week. Okay, all right. So for those who have just joined us, great to have you today. Please follow us on Facebook, like and share, so more people can actually see us live. Yeah. And today I'm going to share with you, of course, the updates of the markets, and then we're going to do some training on the um, price action trading using the SPX as an example. And at the same time, after that, we are just going to actually do some options trading. How many of you love to get free training? Okay. And of course, if you guys have hung on to us on Traders Talk for almost close to 50 shows right now, close to 50 shows. Can you imagine? Yeah, we have been actually sharing quite a lot about trading the stock market, and of course, for those who wants to actually learn how to trade and just get perspective about trading and how you can actually get involved. Of course, you can follow us so that you can actually get the basics. Not only the basics, we even go through some advanced training here. Yeah, and of course, for those people who have already been in training, then of course they would love all those advanced training that we actually give live free on Traders Talk. Yeah, so we don't charge anything. Of course, we do have some training programs. If you like to actually follow us on training programs, by all means. But of course, a lot of things also we share it on Traders Talk. Yeah, and also on our Facebook, you can go and see all the live shows. 40 plus of them, and of course each of them we would actually have a lot of great contents. Yeah, so let's put up the markets. Let's just go through and do a review on the markets and see where the market is, and let me share the screen here. Okay, if this is the first time you guys joining, just give me a love so I know that there are some people first time joining. And of course, for those who are returning viewers, give me a thumbs up so that I also know that you are a good supporter for our traders talk show. Yeah. Okay. All right. So if you can actually see the chart here, please give me a thumbs up. Yeah. Okay. S&P closed very bullish last week with a very bullish bar on the 1 day time frame. If you can actually see, this was actually the close where S&P actually closed at 4158 here, 4158, and with a very bullish bar. So on Friday itself, the bears took full the bull, no, too many bears. Okay, the bulls took full control of the trading day. Yeah, if you can look at the candle, right, I don't think there is even a small little wick tail behind. Yeah, so from the start of the opening itself, the S&P 500 index has actually just shot up till the last time frame for closing. It is also closed at its high for the week. High for the week. But when we actually review the price patterns, right? Okay, um, we also look at what is actually possible going forward. What might be the price trend going forward? Of course, markets can go any direction. It can go up, it can go down. But of course, when we actually do look at price chart technical price patterns, right, we actually try to actually look at what potential it has or based on the price action. Okay, if you look at the S&P 1-day chart, right, since March, right, since March, it has actually formed a downtrend with a particular pattern, which is what we call a lower low, lower high. That means that it's actually going lower and lower and lower. Yeah. So it formed first here one lower low, lower high, lower low, lower high, lower low, lower high, lower low. And at the end here, when it actually reached this price level of about 3,800, slightly above 3,800. This was 3,850, and of course, the week before it actually closed at about 3,814, 15. Yeah, so it went on a lower low, but of course, one thing different from this price trend as compared to the past week is that it did not form a lower high anymore. Yeah, it did not form a low high anymore, but it has actually breached the previous lower high. It has actually breached this point. It has actually breached this point, and it actually closed above with a very bullish pin bar, with a very bullish pin bar. Okay, so what we of course, this is actually showing a break in the trend, a break in the price trend of this downtrend. A temporary, it can be it is a temporary break, I would say, because of this. It has actually broken the price trend, and of course, whether it actually break out above this level and continue the momentum to actually go back up. Of course, this is actually uncertain, but of course, right now it gives us a very bullish sign. It gives us a very bullish sign. Okay, so what we have here is also what we call a double bottom pattern, which is actually formed here. Oops, what is this? Which is actually formed here. Yeah, this is actually the double bottom with a W bottom. This is what we call a double bottom. Yeah. When the price action actually creates a pattern like a W. Yeah. And of course, this was the previous low here, and then the low in the earlier week before it actually went up was here. But of course, closed back above, and then now it is actually above the high of the W pattern, which is what we call here the neckline. Okay, so a lot of traders, of course, would want to also be safe. Of course, to be safe, there are also ways for you to actually see whether it is actually safe. There are actually two a few levels here. Of course, when the first level is, of course, when it breaks back above this line here. Is that means if the price action breaks above this line here. Let me use another color. uh, if first level where we actually do a check is here. How do I change the color? Okay, here, it must be here. Okay, I don't know how to change the color. Never mind, just use red. Okay, so bear with me. So okay, so this I changed the color, but it's smaller here. Okay, so the first level is when it breaks this line here. Okay, so when the price reverses, right, and goes back above the previous low, right? Okay, so this is actually the first level where we can actually see it right here to actually confirm whether this is actually the change in the trend to actually go on a bullish momentum, temporary. Temporary. I use this temporary because to me it is temporary, because overall the price here is still going down. Yeah, still going down. But now we actually just broke one of its level. Yeah. Let me uh, select this. I wanted to delete something. Okay, I wanted to delete this. Okay, so okay, so this, where did it go? Okay, so this was actually the let me make it bigger so you can actually also see. Okay, so last week, what we had here was here, right? So it has actually broken that level, and this level, this is a line, right? Okay, it has actually broken, and within the same day itself, it has actually came up with a very bullish pin bar. Yeah, although it's red, we also call this a bullish because of the long tail, and we can actually see the price action that. There is actually a lot of support at this level where the bulls actually push the price up very strongly. Okay, so of course, with this one candle, we can also formulate that the market is doing a reversal. We can use this as an indication also to actually go long on some of the stocks, yeah, or the index or whatever, yeah. So you can actually use this as one. Okay, but of course, the tendency for a lot of people is also to find confirmations, to actually find confirmations, and normally when these kind of patterns form, very likely it actually comes down, it goes up. it, this is a curved line. uh, no. Okay, when it forms, why is this line curved? Okay, so it goes down, it comes back up, it goes up, right? So when it goes up, a lot of people also wants to find confirmation that we actually wait for a slight retracement to come back to this line before it actually going up again. Yeah, but of course, if you look at the market, we are actually at a very oversold position, and a lot of people are also waiting for capitulation and want to actually jump in the second they actually see a very bullish price momentum. Yeah. Then of course, on that day, the subsequent day to this itself, you don't see any retracement coming through. But of course, the price just went immediately up. But of course, you see it on the next day. You see it on the next day. On the third day itself, the market had actually done a slight retracement, Yeah, with this third candle here. If you have not gone into the market on the second day, some long positions, then of course on the third day here, this candle itself, they actually done during the trading day, some slight retracement, and of course you can also enter into long positions here, and of course the market also closed that day with a very bullish candlestick, where you can actually see that the candle has a long wick, and it actually pushed the price way up, way up, and it actually closed with a doji. Yeah, it actually closed with a doji. Then on the subsequent days itself, the momentum was all the way up. Yeah, and that was actually the first level where we check. Yeah, come go down, bridge below, close above bullish pin bar, do a slight retracement, and then continue its way up. Yeah, so this is actually the first level, and of course, for some traders, they also want a bit more confirmation because, as you guys know, the market likes to play U-turns, like to play U-turn one day up, one day up, one day down. Yeah. So the second level, of course, where you can actually wait for a confirmation, a bullish confirmation or a reversal, is to actually wait for the price to actually go above this neckline. Yeah, we call this a neckline. The W neckline, that goes above this price level here. Yeah. So and of course that happened last Friday. It actually went above this neckline here. Okay, so of course once it goes above this neckline, we call this a free and clear. Free and clear free, we call it free and clear. And what free and clear means that you the green light is on and you can actually go with bullish. That means the price can price up momentum can actually continue. Yeah, but of course again the same kind of price action, even though it is above the free and clear, we can also wait for a confirmation, a retracement down back to this free neckline before actually going back up. Yeah, and of course the same concept, when it retraces, you actually want to see a bullish pin bar closing above this neckline, closing above. It has to actually close above to give you the green or long confirmation. Yeah, long confirmation. So this is what we call this W pattern. Yeah, but again this morning, of course, the S&P, if you actually look at the futures, right, the E-mini futures, it is actually playing yo-yo. It was actually playing yo-yo during the day, where it was up. It was up by 80, 90 points, and then it went red, and now it is actually no, sorry, that was Nasdaq. The S&P was up, then now it is actually down maybe about 13 or 14 points. Yeah, so it was actually playing yo-yo. So basically again, like I said, after a full 5-day rally, right, the market tend to be a bit tired also. If you run if you sprint, right, you do a 100-meter sprint, then of course after the 100-meter sprint, you will feel tired. You need to actually rest a bit before you continue your journey, or on the track to actually continue the running. So again, the market is also same. They might actually rest a while, coming down a bit, before actually continuing the momentum up, So that's why what we had in this the title of this trader talk today is what we also call bull trap. The market makers can also do a bull trap, even though with this kind of breakouts above the necklines, right? It can also be a bull trap. So that's why confirmations is also important. And if you jump straight on, you might actually get stopped out by the market makers. Yeah, this can be a bull trap. Okay, of course, the other side of it, and I'm not throwing cold water to you guys to say that, oh, when the market is bad, you say it's bad. When the market is good, you say it is bad. Okay, so I'm just giving out pointers to you guys to actually uh, um, be a bit careful about sudden this kind of trends, because overall we are still actually going down, right? It's just that this week we actually broke a, a 7-week down streak, and of course when the market went down for 7 weeks, it going up for a week, it is very normal. It's very normal going up for a week. It can continue after that to actually go down again, although it has actually broken the lower low, lower high price action. Yeah. Okay. So the other thing which the market makers can do is this. Although this is actually a W pattern, right? A W pattern. Don't forget a W can also look like this. Let me check. Okay, let me check this. Okay, a W. This is the W, right? Why is my lines crooked? Something wrong with my drawing. I might need to choose brush. Okay, okay, this is a W, right? A very ugly W. Okay, this is a W. And of course, a W can also be this. The W can also be this. A W, yeah. So this is a W. This is can also form a M. That means after this, instead of continuing to actually go up instead of continue to go up, it actually comes down. Yeah, it actually comes down. It actually comes down. Yeah. So of course, when it comes down, then what it forms is this M pattern here. Yeah. You see where I'm going? You see where I'm going? Yeah. So this is actually the current price trend, but if the price does not continue to go up, it actually comes back down. Then the W pattern has now actually changed to a M pattern. Okay, a M pattern is basically a bearish price action pattern, and it can happen here. Of course, when I say this is a neckline, right? Because this is actually when if M patterns form, then basically is what we call a double top. Yeah, just now the W pattern was actually a double bottom. The W was actually double bottom, and when it forms a M, then it's actually double top. Double top is actually a bearish sign. So what happens in a double top is that, of course, this is actually bullish. Then of course when it comes down, then it actually closes with a bearish candle. It actually closes with a bearish candle below the neckline. Yeah, the high of this here closes below, then it becomes a double top, a reverse of the W pattern. So as I said, the market can go both ways. Yeah, it can reverse and close with a bullish candle. Yeah, reverse, close with a bullish candle, yeah, reverse, close with a bullish candle, or it can reverse and close with a bearish candle. Okay, so both ways, yeah, it is not necessarily up, both ways it can go. So you need to actually wait for a confirmation, because this is actually the lower time frame. Yeah, this is a lower time frame, and these are the things that can actually happen. If you look at the higher time frame, if you look at the weekly time frame, right, technically there's no real no real patterns emerging from the higher time frame. Okay, let me just clear this out. Clear this out. Okay. This is a higher time frame. Higher time frame. Okay, okay, this is the higher weekly time frame. But if you look at the weekly time frame, what do you guys see? Yeah, what do you guys see? Nothing much, right? Apart from a bullish candle. Yeah, this is actually a bullish candle. This is actually the weekly time frame. Okay. So on a weekly time frame, basically we have just went to our lows, this year's lows. We have reached this year's lows of what 3810. We have just reached a 3810, and basically we are oversold, and we basically did a 1 day bounce up here. Yeah, 1 day very big bounce of about 6.5%. 1 day 6.5% bounce up here. Yeah. Then, of course, if you look at similar things which has actually happened in March, right? In March, right, we also went into similar situation where we actually went to a very low level here, very low level here. We came up from a bit higher, right? 4,800 points, right? We went 4,008. We came down to this level here. Yeah, and then we close 1 day with a very bullish candle of 6% up, 6% up. Similar situation, weekly candle, 6% up, 6% up. Then what happened in the following 2 weeks? Yeah, we continue to went up for go up for another week, and then subsequently the following week we came down. Yeah, so this was actually the weekly price trend happened in March. Similar situation is can also happen here. We may continue to actually go up in this week. Yeah, but of course, whether it continues its way to actually go back to its high, It's a question. I personally, I do not think it will continue to go back up so fast. Yeah, it might actually go up, play around here. Yeah, before it decides to actually move further up. Yeah, because like I said, some of the things which is within the market, within the US economy, within the global economy. Some things are actually not resolved yet right now. Yeah, not resolved yet right now. Yeah, and we are not going to actually see a V-shaped recovery. V-shaped recovery like what had actually happened during the pandemic, because the circumstances are different. Pandemic time, V-shaped quick recovery, because everything was so bad. The government started to come in stimulus package, print money and all these things. So everybody was getting free money, happy, go up. Yeah. But right now things are different. Recession talks is actually lingering behind the US economy. Government is actually trying to curb inflation, increase interest rates. The global economy, high energy costs, uncertainty in the European region because of the war and all this. So these kind of things will make the market move around, up and down, up and down. Yeah. So that's why when we actually do our trading, right? Like I said, it is not one way bullish or one way bearish. Yeah, we got to actually look at the situation to actually play the trade. And of course, if you're actually going on bullish trade, yeah, by all means go on bullish trade, but of course cut the bullish duration short. Cut the bullish duration short. That means enter and exit your trade quick. Yeah, of course. Like for example, last week, if you have actually gone on any bullish trade, which I hope you did, because I have also went in and closed some of the bullish trades. Yeah, within the same week. Then of course that you will be able to actually catch the profits quick. Yeah, because we do not know what will happen this week. Market might go down this week, or it might continue to actually go up. And of course, if it continue to go up, then by all means do more bullish trade. Again, capture the profits and exit the trades. Yeah, exit the trades. Yeah. Yeah. So, like I said, because of this uncertainty and all, we can actually also use strategies which are neutral, which means that you do not care where the market goes, like where the market goes, or whether the stock price goes up or whether the stock price goes down. Uh, you are indifferent. You are indifferent. Yeah, you're indifferent. Okay. So what type of neutral trades do we actually do, right? Of course, if you are trading stocks, if you're just trading stocks, it would actually be um, a bit difficult to actually do neutral trades, because you buy low, sell high, or sell high, or sell high, buy low. Yeah. So that is actually stock trading. But of course, if you are actually doing what is that doing options, right? Options, you can actually go on what we call neutral trades. That means you are indifferent if the stock or the index you are doing goes up or go high. If it stays within a band of price, you will actually make money. So this today, I would actually like to share with you guys one neutral strategy, options trading strategy, um, uh, which we call, let me just put it up. Okay, one neutral trading strategy, which we actually call, yeah, this is the last Friday, all green, right? Long time never see. This is last week's price, yeah, all green also. Very nice, very nice. Okay, so we actually call this strategy Iron Condor, yeah, Iron Condor. Okay, what is actually an Iron Condor? It's actually a neutral strategy, and basically we actually profit if the price stays within a range. Okay, like I said earlier, right? The S&P 500, right? S&P 500. Let me put this up. Okay, the S&P 500 is actually, you don't know if it is actually going up or going down, right? Going up or going down, right? So you can actually trade within a band, Yeah. So for example, we take in this stock. Did I change the screen? Let me see. Yeah. Okay. So if you actually take this stock, Microsoft, right? Okay, Microsoft is actually currently trading at 273, right? It's actually trading here, 273. It's actually trading at 273, right? Okay. So of course, because the market has actually rallied last week, Microsoft has actually gone up from about 245 here, maybe 245 here, all the way it has actually gone to 273. Yeah, 273. So it has actually gone up a lot from its lows. Yeah, but of course, if the market continue to actually go up, then I would presume Microsoft being a good company, profitable company, would also follow suit with the market to actually recover. Yeah, because all the way from up here to here, it has actually already gone down by 20 over percent more than the market. Yeah, so it can actually go up. But of course, if the S&P goes up, yeah, goes up, then later it U-turns, it comes back down. It comes back down. Yeah, of course, when that happens, Microsoft price would probably also be a bit correlated to the market. It can also come down because of the overall sell off in the market again. Yeah, so Microsoft can actually come back down. So if you're actually just bullish on a single stock, right? You just buy a call, and of course the price goes up. You continue to hold the call. Then of course it might actually come back down. So of course these kind of things. You do not want to happen, and of course like I said, we go into trades which is going to be indifferent whether the market goes up or go down, as long as it trades within a price range. Yeah, so this is what we can actually do, which is we want Microsoft to actually trade within a price range by actually entering into a strategy called Iron Condor, which is a neutral strategy. So if you look at the price here, this is actually the lowest here is maybe about 245, right? 245, yeah, 245. And then of course the levels that we actually also look at the levels of resistance which might have, we can actually see maybe one level of resistance maybe at 290 here. Yeah, 290. Yeah, 245 and 290. So this can be a bottom and then a top where we say okay, 290. So if you have this thesis, okay, Microsoft can rally right now, but of course after the S&P might tire off, it might not continue to actually rally for 2 or 3 weeks continuously. Definitely at one time, it will tire off and it will actually retrace. So when that actually happens, then of course, the price can not shoot up continuously. It can actually go up, and at one time, it also wants to rest and actually come back down. Yeah. So this is our so-called price thesis, which we have to actually go into such a neutral trade. Yeah, and of course, when we do an iron condor, we actually basically do two. It's a four-legged legged trade. Like it's a four-legged trade comprising a bearish and a bullish trade. Yeah, we have a bearish and bullish trade. Yeah, and I will actually teach you guys how to actually structure out this iron condor. Yeah. So again, firstly, understand the price thesis. We want the stock to actually trade within a band, and our current price thesis is that it trades within a band of the low here and at this level of 290. Yeah, 290. Okay. So how to actually structure this? Let me just show you how to actually structure this. Okay, so how to actually structure this is Microsoft, right? Okay, IV rank is 463. You can see my screen, right? Okay, yeah. So IV rank 463, which is actually still very high. So we can actually see also good premiums coming out. And this is just for learning. I mean, this is actually not a trade recommendation or anything. This is basically to actually give you the concept, give you the idea to see how we can actually structure our trades. Yeah. So this is just for learning purposes. Okay. So when we actually do an Iron Condor, we would actually want to actually place a trade which is about 45 days. 45 days. 45 days, which is the optimum trade for credit trades, because 45 days is just the right time for the options to actually decay in value. Yeah. Because when we sell options, right, when we sell options, we collect premium, and we want the option value to actually go decay and go down to zero as fast as possible. Yeah. So that is actually how option seller generates their profits. Yeah. We want the decay to actually come out fast. So 45 days is the optimum days. So 45 days we can actually choose here 200 and this day here 45 days, which is 15th of July, which is just the monthly expiry, just right. Yeah. So this is actually just a perfect timing for this example. Okay, just now we were actually looking at 245 and 290, right? So let's put 245 is here, right? 245. So basically, we actually structure it with two trades. One is actually what we call a bull put spread. Yeah, bull put spread, which is actually just selling a put and then buying back a put at a lower strike price. Buying back a put at a lower strike price. For this, you actually get a credit of 66 cents here. Yeah, 66 cents here. If you do a $5 with, okay, so when I'm doing Iron Condor, I would actually normally target to actually do a $5 width. That is actually my standard, but of course you can actually do it with any width you like, but of course this Microsoft only have $5 width. If you are doing it on SPY or SPY, right, then of course SPY would actually have even $1 width itself. You can actually structure on the lower width. Yeah. Then of course this you get 66 cents. This is one of the leg, and then of course the other leg is actually a bearish leg. A bearish leg is basically what we do a bear call spread. A bear call spread, and of course just now we were actually looking at 290, right? 290, 290 and 295. Okay, so 290, 295. Then of course with this selling a 290 call, and then buying back a 295, a higher strike, $5 width, buying back to actually cap this bear call spread to bear call spread. Yeah, bear call spread. So then of course with this you actually get another credit of maybe about $1. Let's do check again. 295, sorry, 290, right? 290, 290, 295. Okay, $1.28. $1.28, and just now was actually 66 cents. 66 cents was 245, 240. Yeah, 245, 240. Okay, so we actually get this. Yeah, so 245, 245, 290. Just now on the chart, there was actually the numbers which we actually put on the chart. Uh, the price chart was 245, 290, 245, 290. Yeah, so 245, 290. So 245, 290. Then you get $1.94 credit. Yeah, but of course, if I look at the current price, okay, I might also want to actually tweak a bit on the pricing. Okay, so 194 is actually a good premium. because the max loss you get is actually 306 here, 306, which is basically $5 with less the credit receipt of 194. That is actually your maximum loss. Okay, when we do a $5 with when we do an Iron Condor, basically we want to collect premium of at least 1/3 of the width of the strikes. Yeah, the width of the strike here is $5. Yeah, $5, and you want to actually collect 1/3 of it as your premium. 1/3 is basically how much, about 160, right? About 160. So this you get 194 is actually quite good premium. Yeah, but when I look at this, basically maybe I also get how to say, I might say, okay, let's say if I tend to say, okay, Microsoft might actually go up more because it has actually gone down by so much, right? It has actually gone down by so much, it might actually go up faster, and maybe it can actually hit 290 quicker. Yeah, because 290, you can actually see here the delta is 27, which is basically quite quite high. Yeah, so then maybe I will give a bit more leeway. Instead of doing 290, I would actually want to do a 21 delta, which basically gives it 80% probability of profit. You can actually see here 80% probability, 79% pop, which is basically just 1 minus 21 delta, which you get 79% probability for the bearish bear call spread. Okay, so I give a bit leeway. I do 295. I collect less premium. Instead of 120 something just now, right? I collect only 102 for this. Yeah, 102. And on the bearish side, I maintain sorry, on the bullish side, I maintain it at 245 and 240, 245, 240. Okay, so with this, I still get about 168, which is more than 1/3 of the strike of the width. And of course, the expected move for Microsoft, right? Here you can actually see the expected move here, this side. But expected move is 2160, 2160, 2160. Yeah. The expected move is on the right side. Is look at my cursor here. Cursor on the right side here, this blue line here, 2160. What is expected move? Is basically saying that up till 15th of July, Microsoft currently trading at 273 can go up or down by 2160. So 273 plus 2160 is basically 290, right? 295, yeah. So basically 295 here. So we are putting it at more or less expected move. And then on the downside, 273 minus 21 is actually 252, right? 252. So basically on the bullish side, we are actually slightly below the expected move. Yeah. So this is how we actually structure the Iron Condor. Yeah. So based on the price level of Microsoft, to look at potential resistance at 290 just now, and then the support at the lowest level it has actually gone through, which was actually about 230 or 240. Yeah, 230 or 240. Okay, so then of course, if you put this in, the market price will change, of course, when it opens. Then of course, based on that, you can see, based on the same kind of method, looking at delta 20, choose delta 20, to actually get 80% probability of winning on each side of the legs, the bullish and the bearish. And of course, if price stays within 245 and 295 on expiry, then we can actually exit the trade. Yeah. So this is how we actually do this. And the risk profile, I also share with you the risk profile, how it actually look like, and what is your how you actually look at the risk profile. Let me see. Okay. Okay, this was it. 168. Okay. So risk profile is actually here. So Microsoft currently is trading at 273, right? This is the price. So this is the price 273. Okay. So just now we actually set up the price here of 245 and here of 240. Yeah. And just now here was 290, 295. Yeah. So this is actually the price, and for this we actually get credit of 168, right? $168. Yeah. So for this trade to work, right, then there is actually the profit zone. The profit zone is for the price to actually stay within the green zone here, then you up to expiry, you can actually profit to collect this 168 premium. Yeah, and the break even zone, of course, this would be strike less credit, strike less credit. Just now, the credit received for the bull, this is the bull put spread, right? The bull put spread was, if not mistaken, 66 cents. Yeah, 66 cents. So basically, this strike less 66 cents, which would be uh, three, two, sorry, 24434. Yeah, 24434. This is the break even price. Yeah, and of course on the call side, the break even would be the the short strike 290 plus the credit received, which was 101 102, I think 102. So would be two break even would be 291.02. Yeah, so the break even on the top side is 291.12. The break even on the bottom side would be 244.34. Yeah, 244.34. So as long as the price stays within 244.34 and 291.04, you can actually get the full profit out of this. And of course, if it breach below, then you would start to lose on the trade, But of course, this kind of structures we tend to actually exit when we actually reach 50% of the profit. That means 168, right? You actually reach 50% of 168, you can already exit the trade. But of course, there are various kind of management on the trade also, which I do not want to actually go in during today, otherwise we would not finish the show. Yeah, so this is just the basics. Then of course, if you actually want to learn more, you can connect with me. Then, of course, we can actually share more of how to actually manage the trade based on the price actions of Microsoft after you have actually entered the trade. Okay, so this was the neutral trades, which we can actually do. Microsoft is just for an example which I'm showing you, a live example. And of course, you can actually do it on SPY or SPX. Of course, if you have actually done it on SPY for the past few weeks, right? For the past few weeks, then of course the Iron Condor strategy would have been a very profitable strategy to have entered. Yeah, so it is non-directional. The how to say, the trade can be very profitable. When the price goes down, it can be profitable. When the price goes up, it can also be profitable. Yeah, as long as it don't breach certain band. Yeah. Okay. So if you have any questions, please post on it. Wani has one question. What's the difference between VOO and SPY? I don't know what's VOO. What's VOO? I mean, VOO is it that's VOO is VOO. Vanguard S&P ETF. Hmm. Vanguard S&P ETF. Okay, I think it is probably which, how to say, similar ETF but set up by a different fund. Yeah, set up by a different fund. If you look at this VOO, right, the price is actually sorry, I did not share the screen. So if I see VOO, right, the price is 381.8, right? And then if I put SPY, it is 415.2. So the price is actually different. So frankly, I have not come across VOO. VOO, the price is actually different, but the price action is actually similar. VOO, no, no, there is two VO. There is news. Okay, I choose this 381 VOO. It's Vanguard. I think if you look at Yahoo, you can actually also see what is its component. It must have similar but track similar stock component tracking the S&P 500 components stocks. Yeah. But of course, the more popular ETF would be S and this SPY. I mean, VOO, not heard of it. You might need to actually check liquidity and all if you actually want to trade this. Okay, so pre-market right now is green. Is it? No, it's not green. It's red. Pre-market for the S&P mini futures is red, and of course Nasdaq is also red. So this is where I said the slight retracement might come after the 5 days 5 days rally, 5 days rally. Retracement comes, watch for the pullback back to the neckline and form a bullish candle. Then you can actually be more confident to actually go long. If it pulls back and then basically forms a bearish candle, then of course this is actually turning from a W pattern to a double top M pattern. Okay, and of course if you actually want to how to say, if you actually want to revise, right, if you actually want to revise the M and W pattern, right, if you actually want to revise the M and W pattern, if you actually want to revise the M and W pattern, you can actually go to the videos in our Facebook page, right? You can actually go to the videos, not this video. You can actually go to the traders talk, right? Traders talk. So you have all the traders talk here. You can actually go to all the traders talk here and look at this series number episode 36. Yeah, look at the episode 36. And in episode 36, basically, we share in detail the M and W patterns in this show here. Yeah. So like I said, in our past traders talk, right? In the past traders talk, we have a lot of contents trainings about what is that, about trading options and the markets, right? And basically all this actually you can actually refer here, all at the leisure of your time. Yeah, great. Okay, so I think that's all for today, and I hope the short bear market rally, we still call it bear market rally, yeah. The short bear market rally can continue, and of course, it will give back some profits to your long-term portfolio. And of course, if you are trading short-term on the market, you would also be able to profit this week. Yeah. So all the best for you, and good luck in your trading. And I will catch up with you guys next week. Yeah. Bye bye.